How are you approaching China right now? What are you telling your clients?
I think for China, we are still taking a very selective stance. So the whole idea is that, one needs to be positioned in areas where there is a clear policy support and, not really speculate in terms of what could be the next area where we could see potential policy risk. So with that respect, we are positioning more into, companies which are, say, doing quite well on their environmental aspect. They're more ESG aligned because that's clearly, the policy support in China. We're still staying away from very high growth stocks because the valuation and the crowding risk still persists. We really like sustainable yield stocks, which are essentially companies generating high free cash flow yields and dividend yields and have historically been able to generate sustainable free cash flows and dividends. So that's the kind of positioning that we are recommending.
And what would then make you reverse that call on positioning? What will be the trigger?
I think a few things. If we see some bit of moderation further from here in terms of valuation, especially on the growth side of the market, as well as some bit of crowding moderating, that could potentially make us change the positioning, because in China over the long term, we all know it's basically a growth market. So, and some of those growth stocks are right now also reasonably valued. So we are already started picking up some of those names, companies which are not trading at very extreme multiples. Some of the tech names like Tencent, JD, they are now appearing in some of our quant screens as well.
Rupal, I mean, when one looks at China, a lot of it seems to be, or people have said on the show, uninvestable. But we've got signs that the regulatory crackdown may be coming to an end. That may actually loosen up some of these people who didn't actually want to invest to actually go and invest. But there is, of course, the other side, which is some of those national champions that the regime is trying to create there. So give us a sense of how you look at those, because they perhaps are the ones which are a safer bet.
Yeah, absolutely. So, I mean, in China, we do think that, this entire rotation that we've seen this year play out, which is the growth to value rotation, we think that, there is still further room for upside there in terms of value stocks. But we are still staying away from, your classic SOVs, your Chinese banks and real estate. We still have a lot of, risks there. And that's why we think that, to play the newer or to play the older economy side of the market, the yield is a better bet. And on the growth side of the market, one needs to be slightly more selective. These are, of course, all your innovative new age companies, but they still have some bit of risk, persisting there. So it's very hard to sort of say that, most of the regulatory risk is behind us. And hence one needs to be slightly more selective. And we are clearly seeing a lot of, dip buying, which is already happening now.
Well, developed markets have certainly done much better than emerging markets in this part of the world. What would be the catalyst for that to change? And do you see it happening?
Actually, we are still, we remain positive on emerging markets. It's broadly driven by a few factors. One is, yes, emerging markets have underperformed developed markets, but, your earnings outlook for emerging markets still remains quite strong on a relative basis. And that typically is a key driver for outperformance of emerging markets. Secondly, there's always, a yield angle when it comes to emerging markets. So I think based on that, those two parameters, we still think there are opportunities in emerging markets, but of course, one needs to be slightly more selective.
Can I trust the forecast that I see right now in emerging markets, given that China is slowing, because we are moving into earnings season? Just very quickly.
There are always, concerns, or recently, there are concerns around China, growth slowing, and what does that mean in terms of positioning? And in fact, that's broadly why we've become slightly more defensive over the last few months, where we've added more high quality names. We've, actually downgraded value and moved more, sticking more to the high yield side of the names, or even, in fact, following the trend in the market, which will give you a more balanced portfolio. So I think that's the broader positioning that we think is prudent, given the broader uncertainties around slowing growth, inflation, stagflation, and, a lot of other things.
What's your take on the inflation debate?
I think inflation clearly is one of the biggest concerns that investors have currently. And we think that, inflation even beyond this year will be slightly higher than what we've seen play out in the last decade. So it will not be completely unanchored, but we do think that, we can expect inflation slightly higher than what investors are typically used to, seeing in the last 10 years. So that's broadly our view. And hence, a lot of positioning currently needs to be taken or sort of accounted for based on the inflationary expectations that we have.
Does that inform you at all in terms of just sector allocation within equity markets?
There are a few ways that, we look at it. One is, what kind of inflation risk is already priced in the market. And we think that, especially on the margin side, there could be, some disappointment that we can see, because there are areas where corporate margins are actually at historical highs, while inflation is also at historical highs, both on the cost side and the, consumer side. So I think that's one way to look at it, looking at companies which have, say, higher pricing power. And of course, the other way to look at it is historically, what are some of the key sectors or some of the key styles, so to say, which have typically worked well during inflationary regimes, whether you look at it from a broader Asian region or, when it happens in the US.
Rupal, what are we not talking about? What's your top trade apart from what we've talked about already?
So I think our top trade is a few. One is, sustainable yield, which is essentially still looking at value exposure, but in a slightly different way. And that's basically looking at companies which will give you tangible yield, but at the same time giving you some bit of defense. So it's more balanced, it's more less cyclical, but also not completely defensive. So that's one thing. The other thing that we like is, high quality names which have not really started gaining any momentum as of now. But typically we see that, these kind of names, they actually generate much more alpha in the next 12 months. So that's the second kind of, a portfolio that we are looking for, higher quality names, but which have not really, picked up meaningfully in the last 1 month or so. So these are the two key trades that we have on.
So, Rupal, you're really looking at wealth preservation as opposed to enrichment?
Some bit of wealth preservation, yes, given, the broader uncertainty around inflation, valuation risks. We do think that portfolios cannot be completely cyclically, oriented or completely in the growth space of the market. So we are taking a slightly more balanced approach.